So what we'll be discussing today would be the basics of accounting. Now, what do we mean by accounting? What do we understand by accounting, and why it is necessary for any working professional, whether it be a commerce student or non-commerce background person, to understand how accounting works. So, by definition, if I say it'll be the art of recording, classifying, summarizing, analyzing, and interpretation of a financial transaction of an enterprise. Very basic. Accounting is in one equation that we'll be studying very shortly. And everybody who is working professional, he needs to understand accounting, because if you invest somewhere, you need to know how the financials work for a company. So what is an account? Why we study account? What is an account? It is a unit of information that represents business records, because your account measures the your business financially in monetary terms. So anything which is in a non-monetary term, which will not be a part of accounting. So majorly in this part, we're discussing 5 types of accounts: asset, liability, equity, revenue, and expense. What is an asset? Anything that we own, that is in our possession, that is an asset. Whether we use it for short term or long term, that is an asset which you use in your possession. Anything which is in your possession, which is for a period of 12 months, and you have to convert it into cash, that is called as your current asset. Anything which is a long-term possession or fixed asset, that will be depreciable. So that will be for long-term asset and helping business to generate revenue for long-term. That will be fixed assets. So asset has majorly two classifications: fixed assets and current asset. Liability, again, we have a long-term liability and short-term liability, which has to pay it back within 12 months. That is the current liability. Long-term liability, which is due for more than 12 months. Equity, or you say the capital, that is the owner's investment, money in the business, that is called as your capital, or you say the owner's equity, or you say the equity. Revenue and expense, that is if your business generates some good amount of cash flows or incomes, that is called as the revenue. If you have some expenses or losses, that is called as your expense. So we'll divide this classification further in the practical portion that we're studying in. So attributes, as I earlier said, the definition of accounting, the recording of business transactions, whatever that we are making a transaction in a business, that has to have a recorded line. Invoices have to be there, evidence has to be there. In case you don't have a recorded line of a business transaction, that transaction has no validity. Verbal payment, and I'll make you the payment, has no validity till the time you don't have an agreement signed off. So in case you have a verbal, in case you have a say email also, and that too does not have a official legal documentation, like your last point says, compliance with the legal requirements, then also you can't move ahead with the business transaction, because that has no legal validity. Classifying, when we classify, say, in the last slide, I give you an example of an asset. So asset is a broad spectrum. Then we have current asset, fixed asset. Then fixed asset, we have multiple fixed assets. Land, building, plant and machinery, equipment, and so on. So there are a lot of classification of assets and liabilities as well. So we'll consider this in going forward also. The transactions or events of a business must be recorded in monetary terms. As I earlier said, anything which is in the non-monetary term, which will not be a part of your business transaction, because say employee loyalty, customer loyalty, they all form part of your business. Yes, from HR marketing standpoint, they are really good. But when you talk about finance and accounting, in case you don't have anything in monetary terms, sorry, I cannot record it, because I have to have all those things which have a financial implication. If you do not have, if your event or a transaction does not have a financial implication, it will not be recorded in accounting terms. Then we need to summarize all the financial transactions, total it out, and present it in a different way. So when I talk about recording will be forming part of your accounting equation, and you have journal entry to study for it. Classification, we have again accounting equation, and we have ledger accounts to study for it. Then we talk about summarization, we have accounting equation again, and we have trial balance, trading, profit and loss and account, balance sheet to study with it. There's one more part which we got is analyzing. Analyzing will have ratio analysis and cash flow statement to analyze and interpret the financial statements of an enterprise. And they have to be, whenever your financial statements close, if you're a listed company in the Bombay Stock Exchange, or National Stock Exchange, or New York Stock Exchange, or London Stock Exchange, your results have to be communicated to the end users, and that too authentic and fair view, no cheating, right? So what is the accounting equation? Accounting equation is a summation of 3 terms. Assets is equal to capital plus liability. In other terms, if I say What you own and what you owe to the outside parties, that has to be equal. This anything which goes imbalance on left or right, that will create disturbance in the accounting or in the business as well. So anything that you own, that will be called as assets. Anything that you owe to liability as a liability to third party outsiders, that is your liability. Why I say equity is also a third party, because the person who has invested in the business, one day or the other, if he wants to withdraw from the business, he is me incurring losses. He do not want to continue the business with him. He wants to sell this business off to any third party outsider. He can do it. So he can take off the profit, take off the loss, and go off. So that's why equity and liability are shown together. If somebody wants to purchase a business, he can enter, the existing businessman can go off. So this will be considered with the new concept of old concept of accounting called as business entity concept, which says business and businessmen. They both are separate. For businessmen, you are investing as a capital. For business, it's a capital investment, which business owes to the businessman. Someday or the other, they has to be paid out. So assets is equal to liabilities plus capital. That's what we'll be showing in the going forward slide and videos. Economic resources which are owned by the business, yes, they're profitable. They help us in generating profits. That's assets. That's what you own for a business. Owner's claim, because owners have invested money in the business. That's stockholders' equity. That's in green. Liability, any financial obligation or debts of the business, there's always a red line, because that's always dangerous. Obligations, financial obligations come with penalties, interest, and in case you don't pay out, the lender has authority to seal the business houses also. So Kingfisher has been the recent example of that also. So I'll show the next coming up slides with more detail. Thank you so much and have a good day.